Did you know that 90% of active investors fail to beat the market over the long run? It's shocking, right? Even experts with years of experience often make costly mistakes that hurt their portfolios. But here's the kicker. Many of these mistakes are things you can easily avoid. In this video, we'll dive deep into the hidden traps that even the pros fall for, from missing out on undervalued stocks to ignoring how market sentiment impacts prices. We'll reveal the strategies that can help you dodge these mistakes and become a smarter, more successful value investor. Are you ready to learn how to avoid the costly errors that trip up even the experts? Stick around, because you might be surprised by just how much you don't know. Chapter 1. Hidden Value. The pitfall of ignoring undervalued gems in the world of value investing. The focus is typically on well-known stocks of big companies, but there's an often overlooked treasure trove of lesser-known businesses that could be undervalued gems. The secret is understanding that sometimes the biggest opportunities aren't in the loudest stocks but the quieter ones. Benjamin Graham, the father of value investing, once said, "The individual investor should act as his own analyst and discover opportunities in stocks that are being overlooked by others." Many investors, including experts, make the mistake of only considering the stocks with the largest market caps. But what if we told you that small cap stocks, those with smaller market values, can sometimes offer even better long-term potential? According to a study by Ibbotson Associates, small cap stocks have historically outperformed large cap stocks by about 2% annually. It's all about finding companies with hidden potential before they hit the mainstream. So, how do you spot these hidden gems? Look for companies that have strong fundamentals, low debt, solid cash flow, and consistent earnings, but are being overlooked by the broader market. These stocks might not be in the headlines, but they offer the kind of growth and value that larger, more popular stocks can't match. The key is patience. These undervalued stocks take time to bloom. The market can sometimes be slow to catch up to their true value, which creates an opportunity for savvy investors who are willing to wait. Think about Amazon. When it first started, many investors overlooked it as just another online bookstore. But those who saw its hidden value early on became incredibly wealthy. Remember, it's easy to get drawn into what everyone else is talking about, but real value investing means finding those overlooked companies. Value investors who succeed long-term often look beyond the obvious and search for the smaller, quieter opportunities that others have missed. Chapter 2. The dangers of overestimating the margin of safety. The concept of margin of safety is central to value investing. It's all about buying a stock at a price lower than its intrinsic value, giving you a cushion if things go wrong. But even experts can fall into the trap of overestimating this safety margin. They might think they're buying a stock at a huge discount, only to find that it's not really as undervalued as they first thought. Warren Buffett often speaks about the margin of safety. However, even he admits that it's not foolproof. For instance, he paid what many considered an overprice for certain stocks like IBM in the past. Sometimes, markets are irrational, and stocks can stay undervalued or overvalued for longer than expected. It's essential to accurately calculate intrinsic value. Just because a stock looks undervalued based on its book value or earnings doesn't mean it's a good buy. A stock might be cheap for a reason, such as poor management, outdated products, or a weak market position. Always question if the company's core business is sustainable. This is where a lot of value investors fail. They overestimate the margin of safety because they fall in love with the idea of a bargain. Instead of relying solely on superficial numbers, you need to dig deeper. Look at management quality, competitive advantages, and long-term industry trends. These factors will give you a better sense of whether the margin of safety is real. Value investing isn't just about buying cheap stocks. It's about buying great companies at discounted prices. A wide margin of safety doesn't guarantee success. It's a tool to reduce risk, not a free pass to profits. It's easy to assume that the lower the price, the safer the investment. But it's more important to understand why a stock is trading at a discount and if it can recover in the future. Chapter 3. Analysis paralysis. When too much data hurts more than helps in today's digital world, there's an overwhelming amount of data available to investors. Stock prices, earnings reports, P/E ratios, and endless financial metrics are all at our fingertips. While having data is important, there's a fine line between doing thorough research and falling victim to analysis paralysis. This term refers to when you have so much information that it becomes hard to make any decisions. The problem with overanalyzing is that it can lead to inaction or second-guessing yourself. Sometimes, investors think they need every piece of information to make a perfect decision, but this is where mistakes happen. In his book The Intelligent Investor, Benjamin Graham emphasized that a good investor must focus on the basics and not get lost in the noise. He warned against getting overwhelmed by the endless details that can cloud judgment. It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change, he wrote, urging investors to keep things simple. The truth is, the best investors know how to filter the noise and focus on what truly matters, the fundamentals of the business. Sure, looking at the numbers is necessary, but spending too much time on the minutiae can delay your decision-making. You might miss out on opportunities while you're stuck analyzing the same data from every angle. Remember, data is a tool, not the end-all, be-all. It's easy to get distracted by every piece of financial data that crosses your path. But the key to success is knowing when to stop analyzing and make a move. Too much information can paralyze your ability to act, leaving you stuck while the market moves ahead. Experts often get caught in this trap, especially when they're managing large portfolios. The fear of making a mistake can lead to overthinking, but the truth is, no investment is without risk. Being comfortable with uncertainty is key to overcoming analysis paralysis. Trust your research, make informed decisions, and don't let the overwhelming amount of data stop you from taking action. If you're finding these insights helpful, don't forget to subscribe to our channel for more valuable tips on smart investing. Let's dive into more strategies in the next chapters. Chapter 4. The Value Trap. How long-term thinkers get stuck in losing positions. One of the most common mistakes value investors make is falling into a value trap. A value trap happens when an investor buys a stock that looks undervalued but keeps falling in price. It's easy to think that just because something is cheap, it's a great deal, but that's not always true. As Warren Buffett once said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Sometimes, investors buy stocks that are cheap for a reason. Maybe the company's product is becoming obsolete, or it has a lot of debt. These factors make it difficult for the stock to rebound, no matter how cheap it seems. Just because a stock is trading at a discount doesn't mean it's going to recover. For example, look at the case of Sears. For years, it was considered undervalued, but despite its low stock price, the company kept losing ground and eventually filed for bankruptcy. Those who invested thinking the stock would bounce back got stuck in a value trap. To avoid this, always ask yourself, why is the stock cheap? If the reason is fundamental, like poor management, a shrinking market, or unsustainable business models, the stock might not recover. On the other hand, if the company has a strong business with temporary issues, that's a good sign it could be undervalued. A key strategy here is to thoroughly research the company's future prospects. Look for companies with strong leadership, a competitive advantage, and a clear path to recovery. If these elements are missing, the stock may never bounce back. In his book The Little Book of Value Investing, Christopher Brown warns that value traps are dangerous because they disguise themselves as great opportunities. Don't let cheapness cloud your judgment. Stick to your strategy of investing in companies with strong growth potential, and don't get stuck in a losing position just because the stock is cheap. Chapter 5. The Bias of Familiarity. Why home bias can cost you big. Another mistake many investors, even seasoned experts, make is falling into the trap of home bias. This happens when investors tend to favor companies or markets they're familiar with, often those based in their own country. It's understandable, but it limits your opportunities and can cost you significant returns. In fact, a study by Vanguard found that U.S. investors hold nearly 80% of their portfolios in domestic stocks, despite international markets offering better diversification opportunities. When you limit your investments to one region, you miss out on global growth. For example, emerging markets like India or China have shown impressive growth over the past decade, often outperforming domestic stocks. By not diversifying internationally, you limit your ability to take advantage of these high-growth regions. Peter Lynch, one of the most successful investors of all time, believed in the power of local knowledge, but also acknowledged the importance of thinking globally. He said, "Invest in what you know, but don't forget to look at what others are doing." Even though he was a fan of investing in companies that you understand, he also urged investors to look beyond their local markets. International markets offer a different set of risks and rewards. For example, Asian markets might have greater volatility but also offer higher returns. Over time, an international approach to value investing can help balance risk and increase your chances of finding underappreciated gems that are outside your domestic market's radar. When you think only locally, you're limiting your opportunity set. International diversification is one way to reduce the risks associated with investing in just one market. The truth is, the best value investing opportunities often lie outside your comfort zone, in places you're not as familiar with. Experts like Warren Buffett have often recommended that investors diversify globally. He said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing. By focusing on both domestic and international markets, you give yourself a wider field of opportunities to spot undervalued stocks." Chapter 6. Ignoring the silent killer. How market sentiment drives value stocks. As value investors, we often focus on the fundamentals of a company: earnings, revenue, debt levels, and management. But there's one factor that can drive stock prices just as much, if not more, than the numbers: market sentiment. Even a fundamentally strong company can struggle if negative sentiment drags its stock price down, and this is where many investors make a mistake. They forget that market psychology plays a significant role in stock prices. As Benjamin Graham explained in The Intelligent Investor, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that sentiment can move prices in the short term, but over time, the fundamentals of the company will ultimately determine its true value. However, in the short term, the market can be driven by irrational emotions like fear, greed, or even herd behavior. Think about how the stock market reacted during the COVID-19 pandemic. Many stocks, even those with strong fundamentals, saw their prices plummet because investors were gripped by fear. Yet, as the pandemic subsided, those same stocks rebounded strongly. Market sentiment can change quickly, and those who understood the fundamentals were able to take advantage of these price swings. This is why understanding investor psychology is just as important as analyzing financial statements. If you can predict how sentiment might affect a stock, you can get ahead of the crowd and make smarter investment decisions. It's about spotting when fear or greed is pushing a stock's price away from its intrinsic value. To do this, pay attention to market trends and news cycles, but don't let them dictate your investment decisions. Use sentiment as a tool, not a crutch. For instance, when a stock is down due to market panic but the company's fundamentals remain strong, it could be a great opportunity to buy. Conclusion: avoiding these investing mistakes is key to becoming a successful value investor. Recognizing the dangers of the value trap, avoiding the bias of familiarity, and understanding how market sentiment drives stock prices will give you an edge over others. By keeping your focus on long-term value and not getting caught in short-term market noise, you can find great opportunities and make smarter investment decisions. The best investors know that patience, discipline, and a keen understanding of both the numbers and the market's mood are essential for success. If you found these insights helpful, don't forget to subscribe to the channel for more tips and strategies on value investing.